think it was, correct me if I'm wrong, sometime last year, late last year, that you guys got the green light for one of your funds, one of your products, units in China. Give us an update.
Sure.
How's that going?
So we received the second license to build a wholly owned fund management company in China. So this is essentially managing Chinese assets for Chinese investors in Chinese securities and Chinese markets. We've launched 3 funds. We're pleased with the progress. Most recently, we launched one of the first green bond funds in China, which is compliant also not only with Chinese but with European regulatory standards. And so it's early days. This is a 100-year investment, but we built a terrific team and are grateful for the opportunity to participate in the market.
Right, and it's been tough this last year, at least for Chinese assets. Hefty premiums been built in for many reasons, and I'm curious, the people you talk to onshore in China, you were in Shanghai and Beijing,
sure.
and the people you talk to outside, what's the sense you get of what the appetite is? Is the money to take the money out of China? Is the money to take it back into China? Are people warming up to China again?
So in terms of cross-border flows, those have been tough, right? So with regards to our FMC, it's only managing domestic assets, and it's only managing those assets inside of China. We do manage we manage a reasonable amount of Chinese assets that are invested globally on behalf of large institutions, large insurance companies, large pension funds, and the like, and then also manage a much smaller amount of global assets that are invested into China. But those are activities we've been doing for 25 years. The FMC that has gotten a lot of press is really a new initiative, because historically foreigners were not allowed to build, while automobile manufacturers and McDonald's and others were allowed to operate within China, the money managers were not allowed to participate and fully participate. And now they've opened the green door. BlackRock built the first entity. Fidelity received the third license, and we received the second.
Okay, and just your sense of appetite right now of global investors who have de-risked out of China in the meantime, hopefully temporarily?
I think it's tough, right? The people are looking at geopolitical conflict, and while we've made good progress in the very near term, it's against a challenge backdrop, and so we all, as market participants, will look to leadership in Washington and in Brussels and in Beijing, and hopefully we'll have an environment at some point that reflects greater stability. But right now, it's obviously it's tough.
Certainly, this year where things have become a little bit, unpredictable became predictable, is Japan. Like that was really one market at the start of the year no one have really could predict what would have happened. And I know you guys have been in Japan, you have a big presence there. So how has this spotlight back on that market been for you guys? What are you busy with? Because I know you're going to Japan after this too.
I am. Japan, folks are focused on it this year because the Japanese market has outperformed the S&P, has outperformed Europe. But frankly, the changes there have been longer term in coming, and we've seen, I think, both terrific regulatory reform within Japan, as well as really cultural leadership. And Japanese companies today are embracing ESG, are embracing delivering returns to shareholders in ways that they haven't historically. And you've seen leadership from the government, you've seen now leadership from the head of the stock exchange, you've seen leadership from important Japanese investment institutions, and so what's happening beneath the surface in Japan is really quite encouraging. So we've built a great effort, originally focused on large cap Japanese companies, but now where we see particular opportunity is with mid cap and small cap Japanese firms that are embracing transformation in a way that I don't think the rest of the world has fully appreciated.
Okay, now I need to ask you about the U.S. as well. The big question is on the Fed. Are they done? And if they're done, or if they have one more, what does it mean for bond yields, for example? What are your assumptions going into next year on the economy and also markets?
We think they're largely done, if not entirely done. But frankly, it's going to be a function of what happens in inflation, which is clearly decreasing. We think it might take longer than the Fed and market participants believe to fully get back to the 2% level. So our expectation remains that it could be higher for longer with regards to bond yields. And that's causing the economy to slow. And we're seeing it in leading economic indicators. You just saw it with regards to employment data. And so, I think for the U.S., it's a time to be balanced and frankly err on the side of being cautious a little bit. I think you also, as we look at U.S. markets, leadership in the U.S. has been so narrow around
literally a handful, you could almost say.
The Magnificent Seven have, frankly, think that, and if you look, I don't know where it stands today, but when I hopped on the plane to come to Hong Kong, the average S&P company was down 2% for the year. So people are focused on the S&P return, but the average company was not up significantly. And I think folks are repivoting, focused on the broader market and perhaps even looking at mid caps and small caps in some places and looking for more reasonable valuations than what has been a sort of momentum driven.
Is the opportunity to look beyond the public markets at this point? As a final question, I guess alternatives, for example, keeps coming up.
Sure, and I think that's a big structural change that's happening in the market. There are many of our biggest clients, large institutions and others, invest for generations. And we're now seeing this transformation happening in the retail market as well, where folks don't need daily liquidity. These are pools of capital that are going to exist for decades. Yeah. And so they are asking the question, if there's a liquidity premium to be earned for savers, what's the appropriate amount of their portfolio to invest, whether it's in private equity or private credit? Our expectation is, while there's some near-term private equity headwinds, our expectation is that folks are going to find a different balance prospectively, and that we're going to continue to see growth in private market investing, both in private equity and in private credit over time.